Hello everyone, welcome back to our channel and welcome back to the Capital Insights Brief Update video. This sits within our Fundamentals Through the Noise series, and today we wanted to talk to you about the gate being the tail and how the Evergreen private markets have failed their first liquidity test. So what essentially has happened is that two of the largest semi-liquid private market vehicles available through the wealthy individuals gated the redemptions in a single week. The funds did exactly what their document said that they would do, and that is the problem out here. The Evergreen wrapper, illiquid private equity and private credit dressed in quarterly redemption clothing has now met its first real test, and the test is resolving the wrong way. When the gate is a feature, the moment that it engages is the moment investors learn that liquidity was always conditional. So what exactly did happen? Let's talk about the event out here. Now, Partners Group capped withdrawals from its roughly $8.6 billion global value C-cap at 5% of the net asset value for the second quarter, after the redemption request reached close to 10% of the fund. Chief Executive David Layton, appearing on Bloomberg, framed the limit as unrelated to any underlying performance or response to the broader skittishness amongst the wealthy clients rather than a problem in the book. The fund makes up around 4.8% of the firm's $185 billion under management. And the move did not stay contained. Partners Group shares fell as much as 18% in Zurich, on track for their steepest single-day drop since 2006 listing, and now down more than a third year to date. The sell-off spread immediately to the listed alternatives complex in the United States also. For example, Blackstone, KKR, Blue Owl, Ares each fell roughly 5 to 6% in the session, none of which gated a single dollar. A day earlier, Cliffwater's $31 billion private credit fund had received tender requests for about 17% of the value and limited them to 5%, having already paid 7% in an earlier wave. Two near runs on semi-liquid wrappers inside 1 week. So let's talk about why this is happening now, the trigger and not the subject. The approximate trigger is 2026 long re-rating of leveraged software companies seen as vulnerable to AI disruption. Now, this is a theme that we at Punjab Capital Research have tracked through Distribution Reset and AI Stack Capital Map. But this spark is not the subject out here. What follows is about the structure that turned a re-rating into a liquidity event. Let's talk about the architecture on trial out here. Partners Group pioneered the structure now under stress. The firm built much of its franchise by engineering vehicles that let thousands of wealthy individuals access strategies once reserved for institutions. Unlisted funds holding private equity and private debt, but offering quarterly redemption windows. The appeal was always the reconciliation of the two things that do not naturally reconcile: the long duration in liquid assets and the expectation of getting money back on a calendar. Now, that reconciliation is a structural fiction and not an incidental risk. The global value C-cap's 10 largest holdings, names such as Diverse Tech, Fortero, and Emeria together account for only around 16% of the assets. The rest sits across hundreds of private positions that cannot be sold on demand at a reliable mark. The 5% quarterly cap and the red warnings on the monthly fact sheets, these are not the falsifiers bolted on for emergencies, they are the load-bearing assumption that holds the wrapper together. The vehicle only functions so long as the redemptions say below the rate at which the illiquid assets can be turned into cash, and the cap exists precisely because that condition cannot be guaranteed. And this brings us to the paradox of the working gate. Now, Layton's defense and the market's verdict describe the same fact in opposite directions. The CEOs read, the cap is a known, disclosed feature, and in a skittish environment, it ensures that you will not see large outflows, protecting the 90% plus of investors who stay. By his account, the machinery worked. However, the market's read is that the gate engaging in the event that confirms the liquidity was never really there. The redemption right that disappears the moment enough people exercise it was a convenience and not a guarantee. And discovering that in real time is what drives the next investor to the door. So essentially, the gate does not stop the run. It announces that a run is possible, and that announcement is an accelerant. Now, the reflexivity is also reinforced by opacity. Loan and position level detail in these funds is thin, which means credit quality can neither be proven nor disproven from outside. Fear cannot be argued down by data that does not exist, so it becomes self-sustaining. Requests rise, the gate engages, gate validates the fear, requests rise again. The cap converts a sentiment problem into a structural one and then locks it in place. And this brings us to why the stock and not the fund altogether. When the wrapper locks, the only liquid expression of the fear is managed as listed equity. Investors who cannot redeem the fund or who watch peers fail to sell the general partner instead. And that is why Blackstone, KKR, and Blue Owl fell hard on a day when none of them gated anything altogether. The market was not pricing a specific fund's loss, but the mechanism itself. The sympathy sell-off is the tale that is being treated as systemic to the model, not idiosyncratic to the Swiss fund. So the bottom line out here being that the 5% gate did its job. And precisely that is why the market sold. Evergreen semi-liquid vehicles work until enough holders test them at once, at which point the mechanism that protects the structure also reveals its central premise to be conditional. This is not a partners group problem. It's the first stress test of the wrapper that the entire industry has spent a decade selling to individuals, and the result puts the architecture and not the assets on trial. And that's what we wanted to share with you in this brief Capital Insights update video. Hope you've enjoyed the video. Stay tuned in for our next one in the series.